Joining us right now for more on the markets is Oksana Aronov, who is head of market strategy and alternative fixed income at JPMorgan Asset Management. And welcome. Thanks for coming in today.
Thank you.
Let's talk about the economy and what that means for rates, because that has to be driving every decision that you're making for investors right now when it comes to fixed income.
Absolutely. And it's really fascinating to me. We had, just a year ago, we were pushing 490 on the 10-year. We had a monster job beat. We had a couple of weak Treasury auctions. We had a beat on the PPI. We had a beat on the CPI. And yet we've seen a rally in Treasuries while risk sectors like equities, like credit risk, have actually continued to move up unabated, even on the events in the Middle East. We're seeing the Treasury rally give up some this morning, but really this is about the push and pull, right, between the geopolitical risks and the strength, the continued strength of the U.S. economy, as well as continued technical challenges to the bond story, to the rate story, and the fact that there are larger Treasury auctions. The Treasury is trying to finance tremendous deficits at a time when the largest sources of demand are stepping back.
Yeah, let's talk about that last part first. Just the massive deficits the Treasuries need to get more and more money, bringing more Treasuries into the market. I think last week's auction was maybe a little surprising with some of the stuff that went, especially with the 30-year. What do you hear from clients? Do they raise these same questions about concerns about, hey, what's going on with the deficits, and do we really want to be buyers at these levels, or we'll hold out for higher?
I think definitely those questions are coming through. They're coming through in the fact that that long end of the curve has been pushed up so significantly. The Fed has only raised 25 basis points since May, and yet we've seen this tremendous push up in the long end of the curve. So finally, right, the bond market is noticing the sort of financial underpinnings. The fact that, of course, the Fed has not been able to get services inflation under control, and now we're possibly seeing a reigniting of inflation because of, oil and some commodities, some other pressures. So we'll see how that plays out. But certainly the technical picture is an important one. We have, something like 30% of outstanding treasuries maturing over the next year and a half. You have the Fed selling $1 trillion of treasuries. You have the largest foreign buyers. China has been lightening their treasury load by about $300 billion a year since 2021. You have banks that are not net consumers of treasuries, right? And all of this is happening as the Treasury is trying to finance $1.5 trillion of deficit spending. So, and when you kind of pick up your eyes and look out over the horizon, right, in terms of secular trends, we're likely going to continue to see more pressures with respect to inflation, because whether you look at demographics, whether you look at some of the green energy initiatives, right, all of those things, the populist trend generally, globally, all of those things are inflationary in the long term.
At least there's got to be a floor that's underneath treasuries when it comes to the yields on some of these issues. Lee Cooperman told us last week at a CNBC conference that he wouldn't be touching the longer-term bonds below 5.5%, because he just thinks the trend is only up from here.
It makes a lot of sense, because historically the 10-year has really been the sum of growth, inflation, and a long-term premium of some sort. And when we just simply look at growth and inflation, right, that should bring us over 5%, and we're not there. And I've been saying that, look, the 10-year is still, even at some of its peak levels a couple of weeks ago, is still very much priced for a 2% inflation world. And if inflation does settle closer to 3%, then that will absolutely mean a repricing at that end of the curve.
So is that where Jamie Dimon gets some of the comments he makes about this, where he thinks, look, not that we're necessarily headed to 7%, but it wouldn't shock him?
I think
businesses should be prepared for it.
I think we're in agreement with that statement. Yeah, I certainly can't speak for Jamie, but I think generally we're in agreement that technical pressures, longer-term secular pressures with respect to inflation, and the fact that I think the Fed is just generally, I think Jay Powell is generally content to sort of demolish this really unhealthy relationship between asset prices, right, and Fed policy. And I think investors waiting for the Fed punch bowl to come back in the event of a slowdown will be wholly disappointed. So unless we see the economy in some kind of a free fall, yes, central banks will probably get re-involved. But a garden variety slowdown is not going to
get the Fed rescue.
No.
So what do you tell investors to do right now? That's completely changed the paradigm of what we've gotten used to in the last 15 years or so.
Absolutely. So what we've been saying is that the next 10 years are going to be nothing like the last 10. There's going to be a lot more volatility to bonds. We're seeing it in the MOVE index, which is settling where we used to live pre-GFC. It feels like bond volatility is elevated, but really it is exactly where it used to live before the great financial crisis. And so we're saying, look, you have to preserve optionality in the form of liquidity because it is paying you, but you absolutely have to attack opportunities as they arise, whether they're related to the banking sector earlier this year, whether they're related to commercial real estate as this year continues to move along. And one area where we think there'll be a very meaningful repricing is corporate credit risk, right? We saw the Rite Aid default this morning. Even before that, this year was already in the top, 5-6 years of defaults, and we're still, 3 months away roughly
so it's
from
not,
the end of the year.
it's not pricing it in yet.
Absolutely not. Credit spreads are wildly optimistic about the default prospects. We've tripled defaults since the start of the year, albeit from very, very low levels. But the default cycle is underway, and we're going to continue to hear the drumbeat. So there's going to be some really interesting opportunities to get involved. And right now, you can sort of clip that coupon at the front end of the curve, but certainly there are things to do for investors with liquidity and with the toolkit to take advantage of the volatility in markets.
Not the sunniest news, but some interesting news for investors. Oksana, thank you.
Great long-term returns.
Thank you.
Thank you.